in talking to clients, public events, talking with the radio show listeners and people that I talk with that are show listeners and people that come into my firm, there's worry. And I always kind of say, the pendulum has swung way to one side, and you know what? It's going to swing back. Why? History tells us that. Yeah, gosh, negative news aggravates me, and gosh, I don't like seeing values go down at all. Just so you know, I'm probably conservative to moderate as an investor. No, and you probably think, Gregory's aggressive. No, I'm not. I don't believe aggressive gets you more. I've got a lot of data and a research, and I do a lot of that on a daily basis. You're listening to me because of knowledge. You work with us at our firm because of what all we know. And I know it's going to get better. Why? History tells me that. The market always comes back. Here, let me give you a stat here. The S&P 500 has been down at least 20% in total return for the trailing year at the end of 20 months in the last 400 months. So the S&P 500 has been down at least 20% for the trailing year at the end of 20 months in the last 400 months. Most recently, June 30th of 2009. In the 20 times, you get that, in the 20 times that the index has been down at least 20 months and we're looking at the past 12 months in total return, the average return for the next 12 months was a gain of 17.1%. I'll do the math for you. 400 months, that's 33 and a third years. So it tells you, and I talk about known risk. We're getting a 10% correction every couple years. In a bit longer period than that, we're probably getting a 20% pullback. But if you look on a calendar year basis, how often does it happen that the year finishes down that much on a calendar year? Yeah, it's not very often. But this kind of changes perspective. Yeah, we have this kind of movement. It's not a surprise, but it really hurts if all your money's in stocks. But when it happens, the average return for the next 12 months was a gain of 17.1%. Takes me into the topic. You don't want to interrupt the compounding. You don't want to if you go make short-term decisions, what are you doing? You're locking in losses. Don't lock in losses. You need to be invested properly, and you need to avoid the interruption of the compounding of your money.